Hello guys and welcome to today's video. In today's video we are going to look at the charts finally, and we are going to learn about charting. So in today's video we are going to see two different variety of charts that are most popularly used by traders and investors, and we are going to learn how you can use these charts to the best of your benefits to make the most of them, right? So without any further ado, let's get started. If you already haven't seen my previous video on bulls and the bears, I would suggest you check out. It will be easier for you to understand the concepts better. So let us start with the bar chart. What you see over here is a bar chart. It is quite popular, and if you remember from our previous session, I mentioned that each price change, each tick that you see in the stock market, it is the representation of the fight between the bulls and the bears. Now each bar that you see over here, it actually depicts who was stronger. Were the bulls stronger or were the bears stronger? If the bulls were stronger, they would push the prices higher up. If the bears were stronger, they would pull the prices down. So what do you understand from this chart? If you notice, each of these bars that are here, they have one horizontal line to the left and one horizontal line to the right. The one on the left represents the opening price, while the one on the right represents the closing price. Now since this chart is set to a daily basis, it will represent the opening price of the day and the closing price of the day. I can change it to a minute basis or an hourly basis or 4 hours or any of these. In an hourly chart, it will show the prices, the opening price for that particular hour and the closing price for that particular hour. Okay, now let's go back to the daily chart and let us try to understand the colors. The green bar depicts that the bulls were stronger, while the red bar depicts that the bears were stronger in this fight. You should note that the opening prices are majorly determined by the amateur traders. Now what they do is, the amateur traders keep piling up their orders, and all of these orders get stacked up throughout the night. Once the market opens in the morning, all of these orders get executed. As a result, all of their orders determine the opening price of that particular stock. Throughout the day, the professional traders keep trading and they keep their eyes and ears open, and they decide what is the closing price of this particular stock. So based upon their trades, the closing price is determined. So the opening price is determined by the amateur traders, while the closing price is determined by the professional traders. The length of each bar that you see represents the intensity of the fight. The smaller the length, the less intense the fight is. The longer the length, the more intense the fight is. Now any safe trader would keep themselves away if the bars are longer. So if I am trading, I would stay away when the bars are longer, which means the market is very volatile. The bulls are pushing the prices higher and higher up, and the bears are pulling the prices lower and lower down. Now in this situation, it is best to stay away from the market. I'm not a professional trader and I don't have to trade every single day, so I would keep my hands off whenever I see that the market is very volatile, because those are the times when I can make huge losses. So I try to stay away from that. The longer the bars, the higher is the intensity of the fight between the bulls and the bears. The bulls keep pushing the prices higher and higher up. As a result, the topmost point that you see over here, it represents the highest point up to which the bulls were able to push the prices. The lowest point of each bar indicates the maximum strength of the bears. If the closing price is closer to the lowest point, it means that the bears were stronger in the battle. If the closing price is closer to the highest point, it means that the bulls were stronger in the battle. Let us now look at the candlesticks. The Japanese candlesticks are very widely used. So each of these boxes with the lines that you see over here are called candles. The lines up top and at the bottom are called the wicks. So the green candle represents that the bulls were stronger. The red candle represents that the bears were stronger. In each green candle, the lower end of the candle represents the opening price and the higher end of the candle represents the closing price. The topmost point of the wick represents the maximum strength of the bulls, while the bottommost point of the wick represents the maximum strength of the bears. Now, which one should you use? You should use whichever suits you the best. I personally use the candlestick pattern, but you can use whichever suits you best. With this concept in mind, we will move on to deeper avenues of classical charting analysis in our following videos. So if you like this video, do give a thumbs up and I'll see you next time. Thank you.